Once again, I'm joined by Julian Brigden, co-founder and president at MI2 Partners in Chicago. Julian, how are you?
I'm very good. I'm actually in Vail at the moment, so that's the time difference.
That's the time difference.
I'm in Colorado enjoying the summer.
That's good to know. That's good to know. Julian, we had you a couple of times on the Citywire platform. In fact, the last time we spoke to each other was in January. So you should be a little bit familiar with our readers and our viewers and the other side of the road. So let's dive right into it. I mean, like, as you a micro strategist, I would like to know from you where we are in this big picture. Where are we in the current global economic cycle?
So, I think if we go back to January, in January, we were starting to see the market sort of talk about this no landing thing. And I think if you fast forward, to be honest, Lucas, 6 months to where we are now, or the best part of 6 months, we're seeing the same sort of talk again. Now, our work has been showing definitively recessionary camp and actually quite a hard landing. In the last couple of months, I think some of that has so there's some signs of some basing, but I do think there's a couple of things that I've been concerned about and I remain concerned about. The first one is I remain pretty concerned about the credit cycle, right? I mean, this is really how central bank policy works. It works via sort of tightening of to the real economy, at least, a tightening of credit terms. And those continue to look as though they are tightening at quite a material rate, both on the anecdotal data and evidence that I've got, actually not just here, but also in Europe, particularly centered around real estate, but also commercial and industrial lending. So that's one area that I'm concerned. And I think that does point to a recessionary outcome. The second area that I've been concerned about is manufacturing. We clearly, as you can see from the German data, have a manufacturing recession. I don't think there's any doubt that we're at levels now that would be commensurate with a recession. The big question, and one we could perhaps touch upon, is, are we coming to the end of that cycle? And somehow do we get this bounce? Okay. Because if we don't, we're at levels, I think, where you're going to start to see unemployment start to tick up. And our work certainly suggests that, and I'm not trying to be Machiavellian here or anything, so, conspiratorial, that the BLS has probably been over-exaggerating the data. I think it's understandable why they have. They have a look-back period where they do their seasonal adjustments of 3 years. That puts you smack into the pandemic. I mean, how the heck you make sense of any of those variability in that period? And then likewise, even if they shorten it up, which I've been told they've been doing up to a year, that puts you smack into Ukraine. So you're definitely dealing with some, I think, some aberrations there. And then the final area is on the construction side. And I think, we've seen some interesting prints, and if those are right, then we've got a problem. Our work suggests that we've just built a lot of houses, and it's not like we're expecting a GFC style implosion, Lucas, don't get me wrong. We're just expecting a slowdown in housing construction. Now, there have been recently some decent prints, and I think we could be falling foul of what I call hyper-financialization. So hyper-financialization is something that I think is extraordinarily problematic in the United States. And I truly, truly mean this. There is a relationship, a really an unhealthy relationship between the performance of the equity market and the real economy, whereby if I said to you, Lucas, what should come first? Should the real economy drive the equity market, or should the equity market drive the real economy?
Chicken and egg.
Yeah, the old classic chicken and the egg. And you'd probably say, well, surely the real economy would set employment, and it sets, spending, and that sets corporate profits, and, so on and so forth. That is not the case in the United States. Statistically, if you look at it, it is the equity market that leads the real economy by about 3 months. And I'm wondering now, in fact, if some of the strength that we're starting to see or is purported to be out there, let's put it that way, is a function of the fact that we've just had a big rally in the markets. And you can see it in certain areas. You can see it, for example, in the some of the real data that you can get on tech layoffs, for example. Tech layoffs peaked in January. When did the equity market base? It based in December. And that is again why you've got, and I fear this is a repeat of what we had in February, early spring, and it started sort of in January, this idea that we're going to have this no landing. Mm-hmm. And this idea that the central banks are done because this time now inflation is much lower. And I wholeheartedly disagree with this premise. The data that we are actually getting now, I think, and we've seen some interesting speeches come from the IMF meeting in the last few days, to my mind, actually should really worry people, because I think if indeed we are seeing a reaction to the equity markets bounce in the first half of the year, then even the weakness that I'm seeing in some areas of credit will probably prove to be transitory, and growth will reaccelerate. And the problem that I fundamentally see is that nominal GDP is simply growing, certainly in the United States, and also to a certain extent in Europe, far, far too robustly.
Perhaps let me push back on a couple of things you said, and let's see if you have an explanation for that. While we indeed, I would say, have seen some cracks in the labor market, especially in the temporary service sector. Yep. If we look at the credit impulse, for example, and take the G5 credit impulse, we see that especially Asian credit impulse seems to be still robust, especially from Japan and China. On the other hand, what is slowing the impulse down is the US, Europe, and also the UK.
Yep.
And on the other hand, you have then also the manufacturing sector. And if you're there, look in the US, the regional Fed service, the Dallas, the Fed, the Empire State, whatever, we can actually see some kind of bottoming process there on recessionary, so sub-zero levels.
Yeah.
What do you make out of that? Isn't it a little bit contradictory then?
Yeah, I mean, I think things are contradictory. As I said, I think there's a lot of stuff that's sort of contradictory. I mean, if we look at the liquidity impulse, I agree with you. I think we continue to see BOJ impulse, and we don't think U8 is looking to move anytime soon. Doesn't mean that we wouldn't see something in the currency, because I think MOF is getting increasingly concerned around this sort of 145 level. That's ongoing. China, I agree with you, although I think you've got to be a bit careful here. The rate of change in China is rapid, but the level is actually incredibly low in comparison to prior periods in time. The US is definitely tightening, and I think that's one of the ones that we've really got to watch. A lot of people, got ourselves to some degree too, got excited by the prospects of the TGA getting refilled and that draining net liquidity out of the system. And essentially that's been achieved by pulling money out of money markets. So those two have basically negated each other, and bank reserves are still where they are. But a lot of people that I respect, and this is an incredibly difficult job, and it's certainly not my skill set, so do not take what I say for gospel in any way, shape or form. But I was looking at some forecasts. I think I looked at the JP Morgan one and the Morgan Stanley one and a couple of others, and they were all talking that they think bank reserves falls quite materially starting in Q3 because Treasury is going to be forced to start issuing longer duration debt. And that will come out of the bank reserves pool, almost certainly. And that will start to lay on, you've seen all these charts, Lucas, where we look at, bank reserves and the equity market. I mean, they're
one-to-one correlation.
One-to-one correlations. So I think that is definitely a risk. But I think, and look, I think that the manufacturing sector, as I said, is in recession. Is it basing? I think the setup in manufacturing is interesting. I think I'm a big fan of listening to what these guys actually say, and there's a number of podcasts and things you can actually catch these guys and get their sort of input. And one thing that struck me was a comment by the chairman of the ISM US manufacturing survey, and he said, we're kind of in an okay situation, right? This thing has been relatively soft up until now. It's allowed us to draw down any of our excess inventory. So we're not running excess inventory. However, we've used all our backlog of orders up. There is no more fat, in the cupboard to feed on. So right here, right now, even though we're kind of lean and ready to go, we need new orders to come in. And I think, to my mind, that's the big question. I am skeptical those new orders will come in. I don't see where they would come in from. When I look at manufacturers' customer base, and you can get this in the US, you can look at their, in the ISM manufacturing, you can see their customers' inventories, not their inventories, not the manufacturer's inventories, but their customer inventories. And those things have exploded. And we had, I think, an inventory overhang in their customer base. Now, if I'm wrong and this stuff comes through, manufacturers will raise production. They don't have to go to the closet anymore and pull out the product that they made 6 months ago. There is no product there. They've run those inventories down. So I think this whole thing is on a bit of a knife edge right here, right now. If we get new orders, if we are seeing the impact of this hyper-financialization, in other words, some of the employment data is not going to prove, this is hard because like the BLS is over-exaggerated. Maybe they start to under-exaggerate even as some of the underlying data actually starts to improve. But, this is the complication of trading markets. As I said, this weakness will manifest itself, but it won't last. And in Q4 will be re-accelerating again. And I just do not believe, and certainly in the US, Powell has to be much more circumspect about how he talks to the media than Lagarde does. I mean, Lagarde was pretty forceful, I thought, at Sintra this week about wages and wanting to see that slow down. Powell has to be much more careful because he has a dual mandate and he tends to get criticized by Congress quite a lot. So he has to talk in roundabout terminology, and he did. He said a period of subtrend growth, slack in the labor market, right? He wants to see these things. And what does that mean? It means, either, negative GDP growth and rising unemployment. Now, I think the setup is there, Lucas. My indications are that we're going to see it. But if the data starts to reaccelerate in the next, and I would give it a month or so, then what that's telling me is these central banks, as this inflation is coming down, real growth and nominal GDP is not coming down, right? Real growth is trying to reaccelerate. And here's the thing, if this was 2010, 2011, where we've got, very, very high levels of unemployment, we could have a period where we had 3, 4, 5% real growth, right? This is what the bulls don't understand. If I laid out the most bullish scenario that I think an equity guy would want, they'd say, inflation goes away, the Fed is done, off we go to the races. And I'd say, okay, well, nominal GDP is unchanged at 7, inflation goes to 0, real growth goes to 7, okay? Because it has to. That's what the equation is, right? Inflation 0, nominal 7, real equals 7. How do you have 7% real growth in an economy with 3.7% unemployment? You can't. And all that will happen if they try to do that is we'll try and rehire people, and we'll have this period where headline inflation falls and core inflation driven by the wage market will rise again or stay sticky. And then those base effects, because all we're seeing at the moment, literally all we're seeing, Lucas, is energy prices dropping out. And energy prices, that basing actually of those headline inflation metrics, I think probably happens in July or August. I think we will probably see headline inflation rates tick up a little bit and stop falling quite so aggressively. And I think this is where this could set us up for central banks that have to double down.
So the potential of more rate hikes than the market is currently pricing.
Yeah, I mean, certainly in the US. I mean, the US is a very, this assumption, I mean, we're at 5.25 now on Fed funds. I think the Fed may have to go to, I mean, judging by this, they're certainly go, well, they obviously will go in July. They may have to go in September.
Yeah, Powell was today speaking in Spain and was basically saying that they see the potential of hiking 2 more times.
Yeah, and look, and I can tell you from my policy contacts that the reason why they're very reticent to go to 575 in September is that there is a fear that at that point you baked in a hard landing. And I think the fundamental problem, Lucas, is this bloody equity market. And I truly do mean it. I don't, if I look at all my relationships and all my models, you cannot have a rallying equity market and slow this economy down very easily in the United States. It just doesn't happen. And if that's the case, then as one of my colleagues likes to say, the beatings will continue until morale improves. So they will have to keep going. You know, they'll try and back off. The data will reaccelerate. They'll either come in and be forceful, or they'll lose the control of the long end of the bond market, which I don't think they'll want to do.
Because you touched on the equity market, let's stay there for a couple of minutes.
Yeah.
It feels to me like every rally these days is the most hated rally in history. But looking, for example, at both our positioning of fund managers, we still see a rapid, basically short position or underweight in equities. On the other hand, for example, we had a Citywire event 2 weeks ago where there were like 100 fund managers and wealth managers. And in some meetings they were telling me, well, oh boy, I think we have the feeling that we're positioned on the right side here of the portfolio. We have so much cash and we haven't put it to work now. Perhaps in the next couple of weeks, it's still time to do that because the market goes up and up and up and is driven by this AI tech frenzy that's still going on in the market. What do you make out of this positioning game then?
You know, it's tough, but the problem comes is I don't think this is kind of net negative, right? I mean, my sense is that positioning is actually, I agree with you, there's definitely cash on the side. Don't get me wrong. You can look at the money market funds, right? You know, there's a ton of cash in there. Could you squeeze this thing materially higher? I guess you could, but when I look at underlying liquidity right now, and I look at the relationships that we all look at, I like to look at things like, you know, this Fed balance sheet, TGA, reverse repo relationship. We're extraordinarily stretched relative to that relationship. We are exactly where we were in March of 2021, or actually March of 2022. So I don't think it takes a lot to get a little bit of a correction. And I think to your point, that's when that money would come in. If you got a 10% dip here, just because stocks never go parabolic forever, right? I've lived through numerous frenzies, right? I did in, 2008, I was there in 2000, 2001. And parabolic moves, such as the like that we're seeing in NVIDIA, are hugely profitable, obviously, right? Hugely profitable. But they're inherently unstable because it's like the jet fighter that goes vertical, okay? The thing goes up, you look at it and you're like, wow, this thing is really going to the moon. Well, obviously it can't, because at some point it runs on a conventional engine and its jets run out of oxygen to suck in. So a stock that goes parabolic runs out of marginal buyers, right? And then, I'm not sure exactly what the altitude, the season ceiling altitude, max altitude on an F-16 is, but I think it's like 39,000 feet. I should really look it up. At that level, it doesn't go parabolic and fly off sideways. The engine splutters. We've all seen it, right? In the movies, the engine splutters, the plane drops like that, and you hope that you catch it at some point. And to my mind, that's the danger in some of these stocks, right? We're coming into half year end. I think if people were going to position, they were going to position now. I would like to see what happens in the next few weeks. As I said, I think tactically this market looks quite stretched to me. I would not be committing new money to the market here, but I do agree with you. If this thing dips 10%, people will be back in. The thing that I'm most intrigued about, Lucas, is where people put the money, right? And what happens in the US as if we get that Treasury starting to issue duration, right? Because there's an awful lot of money that has to be, a debt that has to be issued, right? There's a massive net issuance this year, double of it next year, right? That money has to come from somewhere. The Treasury Management Committee, which is kind of the prime dealers who talk to Treasury and help them manage the liquidity in the market and talk about the Treasury market, we have been saying they really don't want bill issuance to go above 20% of total issuance, right? You don't want to be only rolling trillions of dollars worth of bills every 2 months, right? So fast forward to, maybe we've got a 10% correction, 5% correction, something like that, but we're still in a broadly upward trend. Then what happens to that liquidity, right? If they start to draw down from there, and this is why I think right here, right now is so singularly important. I'm not one of these guys who just goes, well, I think this goes 3 months out, we're down 10%, but then everyone's going to rush in. So I'm just going to stay long and I'm going to let 10% run against me, because I don't know what's going to happen in 3 months' time. If suddenly Treasury decides that they're going to issue all 10s and 30-year bonds to raise all this new cash that they've got to do, this new net issuance, I'm telling you the equity market is going down. And it will be a classic example of crowding out, where all this liquidity that you've got in the system will end up having to go into the Treasury and the bond markets. And I think this is what people totally forget. In the absence of central banks buying or printing new money, right, which is bloody hard for them to do with inflation where it is, right? Japan, China being the exceptions. Who is going to buy all this new net issuance? Where is that cash going to come from? Well, it has to come out of savings, or it has to come out of existing assets. And the big one, where all the money is in all the world, is the United States equity market. I mean, this is, so my question to you and to your readers is, okay, the market's down 10% over the next couple of months. Which equity market do you buy? Do you go buy more NASDAQ? Because you own a lot. All you Germans who are watching this, and Austrians and Swiss, you own a lot. You have funded the largest current account deficit the US has ever seen. And you funded it in equity. So you're going to buy more? Or you're going to look for other places to put your money? And I think that's the big question that we have to answer. We don't know yet. We'll see. But I think my temptation is not to be uninvested. It's the question of what do I want to own?
Interesting. So if we combine those views that you kindly shared with us right now, if it's the divergence between the real economy and the equity market, or it's the perhaps mispriced front-end curve of the bond market, is there something like a trade that you would like to make out of this for the next?
Yeah, I mean, I'm looking at some of these what's now called the SOFR contract. So this sort of front-end interest rate contracts that used to be euro dollars. Mm-hmm. I'm looking at those and thinking some of these look pretty mispriced and could move a lot. And maybe you balance that when you get the technical signal, if you get the technical signal, with shorts in equities, but you haven't really got that definitive, they're out there. And that's why I'm saying my gut is this is an equity market that looks very extended right here, right now. And let's get through half year end. Let's get into next week and let's see how this thing trades. But if it doesn't back off, then bonds are mispriced.
Julian, thanks very much again for your time.
Pleasure, Lucas. Thank you very much for having me on the show.